Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And something I wanted to ask Mr. Greg Dickerson, what does he do with dead money? Or how does he teach? What does he talk about? And again, dead money is money or equity you have in an asset that maybe you leave there, maybe you don't. So let's welcome Greg to the show. How you doing, sir?
Doing great, Michael. Good to see you.
Awesome, man. What do you think about that whole notion of dead money? Are you, is it a thing? Is it a word that you would use? Do you actually look at recycling capital? Do you just leave it there and pay stuff off? What do you think about this concept?
Yeah, I've always recycled capital along the way and refinance properties, pull equity out to grow and, with companies, with properties, things like that. My philosophy has been, to earn the most amount of money with the least amount of time, energy, and effort possible while minimizing taxable events, things like that, and to grow and compound cash. That's been my goal, to stack that, not necessarily property or assets, more of cash. And a lot of people may or may not agree with that, disagree, whatever, but cash is king. When the chips are down, cash is king.
Oh, yeah.
And, that's what gets deals done. And that's what, he who holds the gold makes the rules, right? And right now cash is gold. So it still is until it's not. And, it may be one day that it's not, but that's always been my philosophy. But yeah, obviously if you pull the capital out, then it's a non-taxable event. You can leverage it and use it to buy other, to grow and scale your portfolio. So that's if you're, in a growth mindset. And, some people may want to use cash flow to pay properties off and own them free and clear, or assets and own them free and clear and not pull the equity out. And, it's an individual thing. It all depends on what your goals are, where you are in your life and what you're doing. And with me, when I was younger, taking a lot of risk and building equity fast, it made more sense to pull the equity out, utilize that, hold the asset for a year and then sell it, because I would get, a short-term gain that could, capture some appreciation, those types of things. In the meantime, I was able to leverage that equity and then keep it growing from there.
Yeah. Yeah. That's one thing that I don't think is talked about. There's lots of people that ask questions, but I think you're right. There's so much about stage of life, right? If you're just starting out, recycling capital was a huge part of our growth. I wouldn't be here today without it. But, when I'm 65 or 75 or whenever I want to kind of be done, then it's going to be about, okay, 50% LTV across the board or whatever it is, because it's just not going to matter, right? I'm going to have enough. The cash flow is going to, fund everything. So I do think you're right. It's the phase of life. Are you growing? Are you stabilizing? What are you doing? I think that's pretty well said.
Yeah. Recycle, compound, it's the Burr strategy. We've been using it forever. People have been using it in the industry forever. And, before it was a buzzword and a meme. And you can use it with businesses, companies, real estate, all types of assets. And, and then people will get to a point to where, hey, if my day-to-day is taken care of and I have some discretionary income to do whatever I want to do, and I just don't want to take any more risk, I don't want to do anything else, they can use the excess cash flow to pay the loans down, then they owe them all free and clear, and then purchase cash, purchase properties with cash moving forward. And you can do that at all levels with all types of portfolios. So every strategy, everybody's strategy is different. Everybody's, place in life is different. And it's, like long-term holding, like we had a thing the other day about diamond hands and holding. And some people, disagree, some agree. Some people say the most wealthy people in the world, have gained that because they held forever. And again, it all depends on what your basis is getting in. Not everything goes up always forever.
And what you're holding, because if you're holding crap, it's always crap.
You never know, and real estate markets go in cycles. Now, property's gone up really forever for the history of time, most areas, but then we've had times where it's dropped down below basis. So that it's all about where you enter and where you're at in the cycle when you need to exit. So things go up forever and holding always works. I mean, that's not always true all the time in every case. It fluctuates. So my thing has always been, you need to know the top, and you need to exit when you can on your terms, not when you have to on somebody else's terms. And that's really the key. Too many people, when they think long-term hodling and diamond hands and all that, they don't think about exiting. Everybody exits, everybody liquidates. You want to do it on your terms, or do you want to do it on somebody else's terms? That's really what you really need to be thinking about.
Yeah, and that's actually something I've been worried about in the commercial real estate market is there's an event, right? There's 3, 5, 7-year terms, or you get a reappraised, and if the value comes in light, you can be forced to sell, even if you don't want. You could plan to hold the building forever, but if that refi comes in a higher rate, higher cap rate environment, and you don't have the money to cut the check, you could be forced to sell, right? They will take it over, kick you out, force to sell it. So it
Yeah,
is,
very different times now than when like Warren Buffett, one of the greatest holders of all time, right?
yeah,
He still sells and
yeah,
rotates,
yeah.
but the Warren Buffett days are gone. That strategy is it just doesn't work anymore because he got in before growth, right? So we've seen the biggest bubble in the history of the world recently. So if you're look at Kathy Wood and her portfolio, I mean,
Oh,
she got in the absolute top. And if we look at, the dot-com bubble, it took 10 years for those stocks to recover. A lot of those companies, now you're talking about Google, Facebook, all those companies, they got cut down 90%, some of them, and it took a long time for them to come back. So if you're buying them here and the liquidity is running out around the world to prop these stocks up why are stocks where they are? Because of the valuations based on the interest rates, the money that the investors can borrow and leverage to make these trades and drive these assets up. So what you're seeing now is a deleveraging, and as the rates increase, that leveraging ability goes down. Central banks tighten up. You won't be able to leverage up as much as you can. So these 30, 40x valuations, they should be 20. So what we're seeing is a return to norm. So the question is, well, that could last another 10 years before they ever get back, to where they were, unless Powell just comes back in March and says, never mind.
Oops, just kidding.
We're Britain,
Yeah, I just put in some more paper. We're good.
I love his printer. You ever see those printer meetings with Powell? It's hilarious.
It's hilarious. Yeah, one of the things that's funny, because one of the stocks I was trading back in the day was Cisco, and again, people could go just Google it, right? Cisco traded at whatever it was, 79 in late December of 99. 22 years later, Greg, it's still not back.
So there's a article out there about that CEO of that company that made this infamous speech, and it's very short speech, and he's like, what were we thinking?
Yeah.
That was the title of it. And he talks about the valuation on a company that had no earnings at 100x. He said, we would have to we would have to make no profit, put no money into research. He's just all these little things that he cited in order to return to the investors a dividend. He's like, what were we thinking? It's pretty incredible, to go back and hear some of the CEOs at that time going, it was just nuts.
It was nuts. Yeah. It was crazy. Well, I have, let's sneak it in here. I was going to make it a fifth video, but we'll do it right here. I know our time is short. I want to talk about the yield curve, right? The yield curve is often cited as a recession indicator, where when the 2 is above the 10, that is often quoted 2 and 10s. It is flattening, right? And I think what that means is the Fed controls or has most influence on the short, right? That's what they influence. The 10-year is really where out there. And I think what it's telling us, because it's not rising as fast, the spread's only 0.6 today. I checked this morning. I think they see stagflation. I think the bond market is trying to tell people the economy is not healthy. Is that fair?
Yeah, that's the message it's sending and signaling. And I think the last time we saw these conditions was it 2018, 2019, when the yield curve was inverted. And
2018.
Yeah. So, the Fed had to reverse course. So, they're kind of saying the same thing. So, the real question is, the Fed sent the markets a message, party's over. The markets are sending Fed a message. No, it's not.
Yeah. No, we don't believe you. That's what they're saying. Yes.
Yeah. So we'll see who's right, but the general thinking and consensus, and really you can prove it back through the history of our markets. The bond market is always right, and it's always forward looking.
Yeah.
The markets are never wrong. So, people can agree or disagree with that, but you can back check that throughout the history of time. And that bond market's always been pretty good.
Yeah, the bond market dwarfs equity market. People don't realize how big the bond market is. And yeah, historically speaking, there's just so much money in the bond market. And that's actually going back to, I think, conversation number 3. That's why I'm particularly nervous about quantitative tightening, right? We've seen quantitative easing. We know how to do that. We haven't proven quantitative tightening and how to do it. And the Fed released a paper, I want to say 2 weeks ago, on their thoughts. And it was a hard read. It was very theoretical. And I'm like, these people don't know what they're doing. It's going to be messy, I think.
Yeah. I mean, it's, there's a lot of uncertainty out there, and, Yeah, but the good news is there's always opportunities too.
Oh yeah,
And,
for sure.
A lot of people that, maybe watching this didn't go through 2008 and 9. They didn't go through, the 2000s. So they really don't know what it looks like when these things happen, and they think we're being bearish and doom and gloom and all that. And it's really not the case. It's
Not
just
at
that we
all.
know what can happen.
Yeah.
We've been through it. We understand, and we've seen it firsthand, what happens when these market accidents occur. And, we're on the verge of one right now. And, the cryptocurrency space, Bitcoin, did not exist during any of these cycles.
Yeah.
The only thing they've seen anything close was the March pandemic, sell-off, which was temporary.
Yeah.
And you saw how they reacted. So, you just got to be careful. You just got to be aware. You got to follow the markets and, pay attention to the bond and, yield curves. But more importantly, it's the Fed. And it's not what they say, it's what they do. What they say can help you make short-term decisions, but what they ultimately do in terms of instituting the policy, that's the key.
Yeah, I couldn't agree more. Yeah, this is going to be an interesting time. 2022 is going to be interesting. And again, I am not bearish or I'm not afraid on all that. I'm excited. There's a lot of money to be made when, prices, assets reset, fear comes in, people rush or panic. It's a great time to be very selective and make some money moves. So I'm excited.
Absolutely. Yeah. I'm opportunistic. And it's funny, like you talk about comments, somebody put down, are those guys short? I don't do that. I don't short. I don't use leverage. I don't do any of that. I'm an opportunistic investor, extremely positive, and, but I know risk. I understand it. I know how to calculate it, and I know what can happen. So you always have to be, as a prudent investor, you always have to be looking for and assessing risk. And, back in my early days, I was nothing but bullish, man. I was like, real estate market, it's just going up. I mean, they're not taking any more land. It's, interest rates are cheap.
How could the Outer Banks go bad? There's more land. Yeah.
Hey, man, I was just like, it's not good, because I was being warned by the old timers that went through it. I'm not an old timer, but the guys that went through the 80s.
And,
right. They were telling me, they're like, man, look, it can shut off like a faucet. I'm like, pipe down, you boomer. You don't know what you're talking about. It's just going up forever.
This time is different.
They were like, all right, young man, come see me in, 10, 15 years. And sure enough, 2008 and 9, boom.
Ouch. Yeah. Very cool, man. This has been a great conversation. I always appreciate our Mondays. It's wonderful to start my week with you. How can people find you?
Yeah, gregdickerson.com. All my info is there. YouTube channel, podcast. Go check it out.
Thanks, buddy. I appreciate it.